Today, we're performing a stock analysis of Danaher Corporation, ticker symbol DHR. This analysis will serve as a holistic and beginning understanding of Danaher to help you determine if it's worth your time and energy to dig in and learn more, which we'll do by calculating an intrinsic value for the business and coming to a rating of the company. Danaher is currently trading for $242.96 per share. Over the past year, their stock price is down nearly 14%. They're performing just slightly worse than the S&P 500 over this time. Over the last 5 years, it's a totally different story for Danaher. Their stock price is compounding at about 20% annually. Over the last 10 years, their stock price is compounding at about 15% annually. And going back prior to the global financial crisis, Danaher's stock price has compounded at almost 13% annually. Keep in mind that the company also pays out a small dividend yield. Right now, the business is paying out a modest 0.4% dividend yield. So that's about a fourth of the yield that you'd be receiving from an S&P 500 ETF, but that would be in addition to this compounded annual return in their stock price. So Danaher is currently trading $10 above their 52-week low. The business is down $60 from their 52-week high. There's not a lot of short interest around the company, and Danaher is a very large business. They have a $177 billion market cap. For more background about the company, in 1984, Danaher's founders transformed a real estate organization into an industrial-focused manufacturing company. Through a series of acquisitions, mergers, and divestitures, Danaher now focuses primarily on manufacturing scientific instruments and consumables in three segments: life sciences, diagnostics, and environmental and applied solutions. In late 2022, the company announced plans to divest its environmental and applied solutions group in 2023, which would leave it focused entirely on life sciences and diagnostics. The company was formerly known as Diversified Mortgage Investors Inc. and changed its name to Danaher Corporation in 1984. Danaher Corporation was founded in 1969 and is headquartered in Washington, the District of Columbia. We'll be performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Danaher based off of their business fundamentals. This analysis is still a work in progress, and it's an opportunity to learn in public, so it will continue to improve and get better over time. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. And there are 2 major reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are likely going to be captured here by return on capital. The second is that the typical publicly listed business earns about a 7% return on capital, so by looking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the quality of the business being about twice as good as average. While Danaher has improved their returns on capital throughout this time frame, the business was earning just about average returns on capital from their fiscal 2018 until fiscal 2022. Since 2022, their returns are more above average, and in their most recent fiscal year, the business earned about a 12% return on capital. However, averaged out over this time frame, Danaher is averaging about a 9% return on capital in a given year. So while those returns are a couple of percentage points above those of a typical business, that's down from that 14% benchmark we were looking for, and so this is an X on metric number 1, starting things off. Next, for metric number 2, here we're taking a high-level overview of the growth of their business. So we're looking for total revenue, net income, and free cash flow growth over the last 5 years. This metric is all or nothing in nature. Either all 3 of these will be up for this to be a check, or if even one of these is down, this entire metric will be an X. Danaher has grown their revenues pretty strongly by about 84%. Their earnings have almost tripled during this time frame, and their free cash flows have more than doubled. With their net income and free cash flow growth leading the charge here, this means that Danaher margins have expanded over this time. And with all 3 of these being up, this is a check on metric number 3. It's particularly great to see that the business had such strong free cash flow growth, because free cash flow is really the lifeblood of any business, and ultimately a business's abilities to produce free cash flows now and until judgment day, discounted back by some reasonable interest rate, is what that business will be worth. A business can use its free cash flows to reinvest back into the business, buy back shares, pay down debt, make acquisitions, or pay dividends. Next, metric number 3, we're taking the perspective of an individual shareholder in the business by looking at Danaher on a per share basis. So we're looking for earnings per share growth over the past 5 years. We learned in our previous metric that their earnings have more than tripled over this time frame. However, earnings are just one part of this equation, and we still want to look at their shares outstanding to see what the business has done there. So Danaher, as a company mainly focused on mergers and acquisitions, has diluted existing shareholders a bit throughout this time frame. They've issued about 4% additional shares in the last 5 years, and while ideally Ideally, we want a business to be keeping their shares outstanding flat, or better yet, buying back their shares when they're trading at a discount to the business's intrinsic value, and it's an attractive use of the business's capital. This shareholder dilution isn't really adding up to much, especially because it's massively outpaced by their earnings growth. So because they have such strong earnings growth, this is very strong earnings per share growth for Danaher over the last 5 years, meaning that this is a check on metric number 3. Next up, metric number 4, here we're looking for something similar. So we're looking for free cash flow per share growth over the past 5 years for the company. With a similar story to their earnings per share, this is also free cash flow per share growth, as the business has more than doubled their free cash flows over this time frame, and they've only had that small shareholder dilution. So this is another check here on metric number 4, and so far through our first 4 metrics, we have 3 checks and 1 X for Danaher. There's still one vital piece of the company's financials that we're missing, so you might think that nailing above average returns on capital and strongly growing a business is key to a company being a wonderful business, but we haven't touched on the one thing that I believe sets truly wonderful businesses apart, which is having these characteristics without using a lot of debt in their business. So here for metric number 5, we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that the business has produced over their last 5 years. And this is because we don't want to be investing in overly levered businesses, because during economic downturns, it's overly levered businesses that are likely at the greatest risk of poor outcomes. Danaher's net debt position has been somewhat sporadic over this time, although they have dramatically increased it since their fiscal 2019. They ended their most recent fiscal year with $14.7 billion worth of net debt, and over these last 5 years, Danaher has produced about $26.6 billion worth of free cash flow, so this is more than enough to be able to comfortably support this net debt position, and this is a big check here on metric number 5. Worth being aware of is that the business has produced about $7.4 billion worth of free cash flow in their most recent fiscal year, so they'd be able to pay off all of their net debt with only about 2 years worth of their free cash flows. So it looks like Danaher is strongly free cash flow generative relative to the debt that they're employing in their business. So far we have 4 checks through our first 5 metrics. The big metric of them all, metric number 6, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this may offer a slight risk premium to the yield of the 10-year treasury and may offer a potential starting point for a reasonable valuation of Danaher. We're using their total enterprise value rather than their market cap because it's also going to take into account their net debt position, so it'll give us a perspective of the company that's more similar to as if Danaher were a private business. We learned in the previous metric that Danaher has produced $26.6 billion worth of free cash flow over the past 5 years, meaning that in an average year they're producing about $5.3 billion worth of free cash flow, and Danaher currently has a $193 billion total enterprise value. So when we divide their $5.3 billion of their average free cash flow by their $193 billion total enterprise value, that gives us about a 2.7% average free cash flow to enterprise value yield for the business. And to get a current free cash flow to enterprise value yield for Danaher, when we divide their $7.4 billion of their last fiscal year's worth of free cash flow by their $193.4 billion total enterprise value, that is only going to give us a 3.7% current free cash flow to enterprise value yield for Danaher. So that's about in line with the yield of the 10-year treasury, although that's down from that risk premium. So both on a current and an average basis here, their free cash flow to enterprise value yields are falling below that risk premium, meaning that this is an X on metric number 6. Just because this is the case doesn't mean you're going to toss this business out in its entirety. We still want to perform a DCF analysis to come to a more concrete estimate of Danaher's intrinsic value, but we've got a bonus metric to cover before we get to that. While these metrics are simple, when they're combined together, they can be very powerful. And I want to reiterate that this type of analysis is not financial advice. As our bonus, here we're looking at Danaher's dividend profile. So Danaher has steadily increased their dividend payouts in all 5 of these years, and they've supported their dividends with their free cash flows in all 5 of these years. Danaher is currently paying out a modest 0.4% dividend yield, and it looks like the business has an extremely modest dividend payout ratio of less than 25% in all of these years, and just about 10% in their most recent fiscal year. So while this is a snapshot of their past 5 years of performance, and it's not a guarantee for the future, it would seem to be the case that Danaher's dividends are likely healthy and supported by their free cash flows and could potentially be very sustainable going forward into the future. As promised, everything we've discussed so far is important, but there's something missing that in my opinion is the main reason to analyze Danaher, which takes us on to using a discounted cash flow model to come to a potential fair intrinsic value for Danaher. So a discounted cash flow model is based off the predictability of a business's free cash flows, and it's just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're starting with Danaher's current free cash flows, and we're using historical growth assumptions for how the business has grown these free cash flows dating back all the way until 2000 in order to project these out into the future. So it's up to you to do your own homework here to determine whether or not these historical growth assumptions will be accurate and applicable going forward to give us a baseline projected estimate for Danaher. If we assume that they grow their free cash flows at a rate of about 10% annually for the next 10 years, and then during the 10 years out after that this growth rate is cut in half to where their free cash flows grow at 5% annually. If we were seeking a 15% rate of return, which is the rate of return that Warren Buffett is looking for from his investments, in addition to his requirements for margin of safety, then it looks like at today's valuations that a potential fair intrinsic value for Danaher is right around $118 per share. Please be mindful of some important factors here. One is that Danaher has not had the highest degree of business predictability in its past, especially as it's been a business that's growth has been fueled by mergers and acquisitions. The company has steadily increased their shares outstanding pretty much for the past 30 years. So that may be a reason that even though they've had a lot of free cash flow growth over this time, the business has had lower predictability than some other types of businesses. Because of this lower predictability, this really highlights the need to dig in and do your own work here. Please be mindful of the fact that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. In just a minute, we'll get to our rating for Danaher, but we have to address something first. What are some of the qualitative aspects of this business? Starting with some of the key qualitative aspects supporting a long thesis of Danaher. Number one, Danaher has plenty of opportunities to consolidate and improve performance in its targeted life science and diagnostic end markets. Number two, Danaher's shift to healthcare markets has created a less cyclical business in attractive markets with high barriers to entry and impressive recurring consumables revenue streams. And number three, the Danaher business system focuses on continuous improvement, including the acceleration of core growth and margin expansion through marketing initiatives and innovation, which appears positive for Danaher's long-term growth prospects. Then for some of the key points around a potential short thesis of the company. Number one, as the pandemic transitions into an endemic situation, Danaher's growth prospects may decelerate. Number two, Danaher faces significant competitions in its target niches and must remain dedicated to ongoing innovation to remain relevant, which is not guaranteed. And number three, Danaher continues to hunt for acquisitions in the life sciences and diagnostic markets, which could constrain return on invested capital, including goodwill if it makes acquisitions at unattractive prices and is not able to integrate them as successfully as they have in the past. So there you have it for a balanced perspective around some of the qualitative aspects of Danaher. Now it's time for a rating of the business. So for our fundamental analysis of Danaher Corporation, ticker symbol DHR, Danaher earns returns on capital just a couple points above those of a typical business, but below the 14% benchmark we're looking for. The business has strongly grown their revenues, earnings, and free cash flows over the last 5 years, but they've had small shareholder dilutions of about 4%. Even still, the company's grown on a per-share basis, and it looks like the business is using a reasonable amount of debt relative to the free cash flow that they're producing. However, on both an average and a current basis of their free cash flows to their enterprise value, it didn't look like Danaher was giving that risk premium in comparison to the yield of the 10-year treasury. Looking at their dividend profile, their dividends and their free cash flows have grown in all 5 of these years, and it looks like the company is paying out a very small percentage of their free cash flows as dividends, so Danaher's dividends look like they're sustainable going forward into the future. Performing a discounted cash flow analysis of Danaher, it looks like a potential fair intrinsic value for the company, if you were seeking a 15% rate of return at today's valuations, is around $118 per share. So down pretty significantly from what the company's current stock price is. The last time the business traded near those levels was back in 2019, so it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisors. With Danaher checking the box on 4 of our 6 metrics today, it looks like the business is a strong candidate in terms of its attractiveness for further research. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Thanks for learning about Danaher with me, and have a great day.